Welcome to this episode of our property investing channel. This is your host, SMSF, and today we're going to be talking about property investing using SMSF. Gerald Kirk, partner at Everest Tax and Property Advisor, is with us today, and he's going to share his knowledge and experience with us. So without further ado, I'd like to welcome Gerald to our show. Gerald, thank you very much for being here.
Thank you, Amir. It's a pleasure to be on this YouTube video.
So just before we get serious, tell us about yourself and your journey a little bit.
Yes, well, I started as a tax agent in 1984. I've been practicing in Mill Park in the northern suburbs. In 2008, we moved to Uni Hill in Bundoora into new offices. We've been a large number of individual and SME type clients. In 2022, I met Sally Wright and we formed a new partnership to expand our business services into tax advisory, CFO advisory, and property advisory. I've been a property developer for 20 years and got out of that business. So I've got a lot of experience in property development, superannuation funds. I'm a registered superannuation fund auditor, and I have several clients that have self-managed super funds with property with limited recourse borrowing arrangements. And
Fantastic. I'm sure that our audience will enjoy this interview a lot because of your experience and your knowledge. So before I basically start asking you questions about SMSF, let me just read our disclaimer, because I want to be clear that this is not a financial advice and this is just to provide general information to our audience. So as I said, this is not financial, taxation, or legal advice. The listener, reader, or viewer acknowledges and agrees that we have not taken the listener, reader, or viewer personal and financial circumstances into account when providing information. We must not and have not provided legal, financial, or taxation to the listener, reader, or viewer. The information provided must be verified by the listener, reader, or viewer prior to their acting or relying on the information by an independent professional, including legal, financial, taxation advisor, and their accountant. Any information provided by us is provided as general information and for general information purpose only. The information may not be suitable to the listener, reader, or viewer's individual circumstances. Right now that we are clear that we are not advising anyone on anything, let's have a chat about SMSF. So can you tell us, Gerald, what SMSF is in general?
Well, yeah, SMSF is a self-managed super fund where the trustees are the members as well. So the members take an active role in managing their investments. They can invest in a wide range of asset classes, including property, which you cannot do if you're in a public superannuation fund. So that's one attraction for people running their own self-managed super funds.
Absolutely. So what type of people think about SMSF in the first place?
The type of people I find are people that want to take control of their investments. They're not happy with the performance of some of the funds, and they like to invest in property, which they cannot do in their current superannuation fund. So in the main, it's people that want to manage their own funds.
But what is the benefit of managing their own funds? Because many of these big super funds, like for instance, Australian Super, they claim that they are doing a great job and they've been in the business for a long time. So they are claiming that the return on investment for the client is very healthy, and basically they are doing a better job comparing to a person without any financial background on managing those funds to invest in shares or in property. So what is your opinion on that?
Well, with self-managed super funds, it's not for everyone. The key is you have to take an active interest. You have to have some fundamental knowledge of investments, shares, property, and you need to seek advice from professionals. And the fees can get lower depending on the size of your self-managed super fund. The larger the self-managed super fund, the fees can be lower because big funds charge on a percentage of funds on management.
Sure.
Whereas a self-managed super fund, it's your accountant's fee is fixed. If you don't have an investment advisor, you don't have that cost attached to it.
Absolutely.
It could be a matter of cost, and small balances, it's maybe not suitable to go into an SMSF.
Yeah, okay.
That, I mean, if you have a long-term plan and you want to grow your fund, the initial cost might be higher, but in the long term, you could come out in front.
This was actually a question that I was going to ask you later on, but you mentioned about the amount of the balance that normally people have in their super and then decide to go to start an SMSF. So can you give us an idea of how much balance is normally suitable for people to start thinking and having the conversation with their accountants to see whether that SMSF is suitable for them or it could be an option for them? And what are the other basically consideration people might to start thinking before deciding whether SMSF is a good option for them or not?
Well, I mean, most super funds, managed super funds, would charge, 0.5%, 0.75% of the funds under management. So if you have balances there's no hard and fast rule, but generally balances under 250, it could be a marginal exercise.
250.
250, I'd say, yeah. Ideally about 500,000. And then if you buy property, you could gear up using a limited recourse borrowing arrangement, which increases the value of the fund's assets.
Our topic of basically this podcast or YouTube is basically to explore the pros and cons of investing in property using SMSF. So can you give us a good amount of information on the pros and cons of property investing using SMSF?
Yeah. Well, the main pro in using an SMSF is people love property. I mean, it's a tangible asset. They might have a inbuilt, sometimes irrational aversion to investing in shares. Shares, is just a piece of paper.
Sure.
So that emotional aspect is there. And people believe property will go up in the long run, and well-chosen property generally does. That is the main pro, where if you love property, you cannot talk to Australian Super or one of those funds and say,
sure,
I want to put a property into this fund. They'll say, no, you're limited. The cons, do you want me to address that?
Yeah, absolutely. Because, when we want to make a decision, we need to understand both pros and cons and then make an informed decision. And before you mention about the cons, may I add a little bit of more information to what you said?
Yeah, sure.
So basically property, comparing property and share is always a debate between lots of people, and we are not here to just say whether share is better or property is better, because they are different vehicles and they help people in different ways to achieve their goals. But the question here is whether to invest under their personal name or if they are basically eligible to use their SMSF, whether to invest using their SMSF. So we are comparing those two.
Okay. Well, the pros in using a super fund a self-managed super fund to invest in property is usually people would have funds sitting in a managed super fund. That allows them to have a equity stake in the property, reduce their borrowings. That is the big attraction in investing in a super fund. People generally, especially when there's a market downturn, people get a bit disgruntled with their returns, and then they look around and say, if I had 400,000 sitting in my super fund, if I took it out and borrowed another 200, I could buy a property.
Absolutely.
That's the big. The disadvantage is, I mean, you don't get the negative gearing. If you purchase a property in your own name, you get the advantage of the negative gearing, but you might not have a deposit. The risk is amplified because your borrowings are greater. But you do get the tax benefits.
So what are these tax benefits?
The tax benefits would be the negative gearing, where your interest cost and outgoings exceed your income. In addition, depending on when you purchased a property, you get depreciation allowances on new properties and capital allowances, which is the cost of the original building cost amortized over 40 years.
Sure.
You get immediate benefits, especially if you're in a higher income tax bracket.
Sure. So you mentioned a few different types of tax deductions and tax benefits. One was the negative gearing tax benefit. The other was the depreciation. And if I'm not wrong, the other one was CGT, or capital gain tax, right?
Capital gains, yeah.
So what happens when you invest in property using SMSF? We don't have any sort of benefit from SMSF investing?
No, well, I mean, the SMSF would have entitlements to the same depreciation, capital allowances, but the negative gearing losses get trapped in the super fund.
Sure.
And in the long term, as the rentals increase and your loan decreases, you get positive cash flow. Then it becomes advantageous to have your money in the self-managed super fund because of the low tax environment.
And
if you
keep 15%, correct?
15%, yeah. And then if you retire and decide you want to sell your super fund, the capital gain presently is totally exempt if it's in a pension phase.
Correct.
It's a big advantage.
Which is basically massive, because if a person sells a property on their personal name, they can be taxed on their marginal income rate, which can be as high as 47%, correct?
That's right, yeah. And especially if you bought a well-chosen property and it's, you've realized large capital gains, it can be a big tax impost. Like you said, it could be 47 cents in the dollar.
Yeah, that's a lot of money that going to the tax man.
And then people are hesitant to sell. They try to hang on to it. And
so we talked about tax pros and cons of SMSF. How about setup costs and ongoing costs?
Well, to set up a self-managed super fund, I mean, it can vary from $1,500 up to $3,000 or $4,000, depending on the complexity. If you have to borrow money, the documents could cost you, around $2,000. Plus, you might have to engage a lawyer or a conveyancer to register the mortgage, set up a corporate trustee for the bare trust. There is cost, but those costs are tax deductible. You claim those costs over a 5-year period. and there are only initial costs. There's no ongoing cost attached to that.
There are costs involved, but as we discussed, there are pros and cons. So if people realize that the cost of having that SMSF actually is okay, and it can give them long-term benefit, they can easily make that decision and proceed with it. Okay, we can use a family trust, for instance, to buy a property.
That's right. Some people do.
Yeah, exactly. Which has its own costs, but it has its benefits like asset protection or the distribution of profit to different beneficiaries. So there is always pros and cons, and people need to realize all those benefits and disadvantages and talking to their accountants for sure before making any decision. This is very important, because it is easy to not take into consideration all the factors and then decide, and then we find ourselves in a position that we don't want to be in.
Exactly.
So what are the typical structures for an SMSF, like corporate trustee or individual trustee, and the pros and cons of those things? Can we explore those things?
Yeah, well, I mean, individual trustees is obviously a cheaper option. You don't have to establish a corporate trustee, a company, which could cost you, $1,500. There's ongoing ASIC fees in the order of about $80 to $90 if you have a special purpose superannuation fund trustee. As an individual, you don't have those costs. But moving forward, there's always that issue of what ownership. If the property is held in individual trustee's name, the titles office only recognize the individual trustees, not the super fund. So if someone did a title search, they would say Mr. and Mrs. Jones own this property. They would not know that they're holding it as trustees. And that could be an issue if they unfortunately end up in insolvency, where the trustees in insolvency would be trying to say that the property was for their benefit rather than the super fund. So you avoid that by having a corporate trustee. In fact, most banks, if they lend, they like to see corporate trustees, and that is the preferred way to do it.
So asset protection, correct? Asset protection is a key concern for people who are preferring actually corporate trustee compared to individual trustee.
And also there's a clear distinction as to who owns the property. It's XYZ superannuation trustee that owns the property and the shares that belong to the super fund. So there's a distinction between the trustee and the members.
Absolutely. Absolutely. So what are the limitations of property investing through SMSF?
The limitation, I think, is initially it could be diversification. Especially people with low balances. They might find 100% of their property of their super fund is invested in property. And that's not good diversification. But having said that, it would depend on at what stage of life the members are. If they're young, it's not an issue because they've got time to repay that loan. Rents do come in. They can then use those rents to diversify into shares and term deposits. But they must diversify. They cannot have 100% in a property.
Correct. So can a person who is investing in SMSF can buy from their relatives or rent their investing property to their relatives?
There's restrictions on, if it is a commercial property, like a shop, a factory, an office, there's no issue acquiring it from the members or related parties, provided it's done at a market rent. You'd have to have a valuation prepared by an independent valuer. You could, if it's a commercial property, you could then rent it back to the members. And members might run a business. They like to own their factory. They buy it in the self-managed super fund, and then the super fund leases it back to them.
So what about the residential property restriction?
Residential, unfortunately, it's a no-no. You cannot acquire residential properties from yourself or from related parties. Very important distinction when you buy a holiday house. So, I'd buy that holiday house in my super fund, and I'll spend every summer at the holiday place. You can't do that.
Yeah, that's very good things to know before making that decision.
Yeah, or you can't buy a farm in the name of the super fund and then rent it back to yourself.
Yeah. So can it be rented out to children or other family members as well?
Not at all. No, it cannot be rented to relatives, children, brothers, sisters. There is a hierarchy that you follow, but generally it has to be done to arm's length, independent people.
So what are the limitations on alteration or, renovation on that property, residential?
If you buy a residential property with a view of knocking it down, putting 2 units on it, you better have your money set aside, because you can only borrow once that property. So if you bought the property for 800,000 and you want to borrow another $1 million to build, you'd have to have that 1 million in cash. You cannot borrow to do that.
So for development project, can people use a still SMSF?
They can, but they would have to have an ungeared unit trust set up. And there's very strict rules on arm's length transactions, and there's huge penalties at up to 47% tax if you get it wrong.
Okay.
So generally speaking, if you're going to do a property development, you need to get expert advice from your accountant. And
absolutely. And it also the same for renovation for profit projects. Am I correct?
Right. Yeah, if you buy a rundown place and you want to refurb and sell it, it's fraught with danger. You could end up paying 47 cents in the dollar.
Yeah, a position that no one wants to be in, paying 47%. Perfect. Absolutely valuable information from Gerald. Thank you very much. So let's talk about cash flow. What setting up cost or ongoing costs investors need to be considered before investing in property using SMSF?
Well, if you're going to borrow from a bank through your SMSF, most banks would want to see at least one year's outgoings in cash as a buffer, just in case you don't get the rent. So you do need to have more cash set aside to cover that eventuality, because the super fund cannot borrow that money. It can borrow money for short term to get out of a spot, but generally you need to have more cash set aside.
So that cash must be in SMSF, right? Not in my personal bank account.
No. It must be sitting in the SMF. Yeah, it might be 20,000, 30,000.
So that is basically another layer of limitation using an SMSF, because if we don't have enough buffer for ongoing costs, basically we are not able to invest through SMSF. Am I correct?
That's right. And also, if you reach retirement and your SMSF has, say, one property, for example, maybe a little bit of cash, some shares. When you're in a pension mode, you need to be drawing down regular payments of at least 4%, going up to 5-6% of your account balance each year to maintain the tax exemption. So if you have, you can end up in an illiquid situation, especially if a tenant doesn't pay or unexpected repair bills. Generally, having a property as the main asset in a pension phase is not good investment strategy. Most people would, when they reach that stage, sell their property, get the capital gain tax-free, and buy some liquid assets.
Yeah, that's the way of doing it, actually.
Yeah, yeah. I mean, you might have 2 or 3 million in your super fund,
Yeah.
and have one property which is worth $1 million, but you got 2 million cash. That's fine. But if your SMSF was, say, $1 million and 700 or 800 of that was the value for property, you're running a bit thin.
Absolutely. And that again shows the importance of talking to our financial planner and accountants and get personal advice, because everyone is in different stage of life, different investing objective, and different financial situation.
It has to be tailored to your needs.
Absolutely.
And it needs to be monitored at least a year, because circumstances do change.
Yeah. So we talked about cash flow. What are the auditing costs of having SMSF?
Auditing cost, if generally, I mean, it could be around the $600 mark. Plus some online audit firms that will do it for as low as 300. But the tax office don't like that, because you cannot really do an audit for $300.
Yeah, makes sense.
Can't do proper justice to it. So I think about 600 for a simple structure, where a property with a few shares. But that cost could go up.
Yeah, absolutely. So again, on that topic of cash flow, how negatively geared a property can be in an SMSF? And what happens if a property is highly negatively geared?
If it's highly negative geared, I would personally say you need to have, I would follow the tax office, the banking guidelines. I mean, they have guidelines for a reason, because they're very prudent and they look at all eventualities. I wouldn't have more than 80% borrowing, because 80% would be a little bit excessive. I would say probably 60 to 70%. Yeah. It depends on the environment. I mean, in an environment where interest rates are currently going up, property prices could be stagnant. You might want to have a lower gearing ratio.
Correct. But for a person who has already purchased that property in SMSF and is now experiencing those interest rate rises, what are the options? Because they are eating out their SMSF money at the end of the day. Am I right?
That's right. Yeah, I've seen clients. They might have bought initially, I think they probably bought the wrong property.
Yeah.
Like, I think clients buying 1-bedroom properties, which are fraught with danger at the moment. A lot of them have negative equity, and the only way forward is for them to make employer contributions. Keep funding it.
But there is a maximum capacity that we can contribute. Is it to 27.5 grand? Is it in that
yes,
mark?
Yeah, 27,500 is the tax deductible, what they call the concessional contribution. But you could also put non-concessional contributions of up to 110,000 per annum.
And what is the tax rate on those contributions?
Non-concessional contributions is really savings you might have in a term deposit in your name, where you've already paid tax on that.
Okay.
Make a contribution to your super fund. No tax on the way in and no tax on the way out.
Okay, makes sense. Makes sense.
In a lot of those cases, people have to then consider their options. I mean, do you sell now and rebalance your portfolio, or do you continue? That's a judgment that they have to make, depending on where you see the property capital growth go.
Yeah.
How far they are from retirement as well. Yeah. Again, they need to get advice from their accountants or lawyers.
Absolutely. And it really shows the importance of selecting a good property, a right property in the first place, because if you're purchasing a wrong property, as you mentioned, a one-bedroom house, it puts you in trouble in many ways, and it's gonna bite you in many ways in future. So it is really, really important to purchase the correct property with the correct price in the first place.
That's exactly, yeah. And a lot of people don't do that. Everyone thinks they are a property expert.
Yes, that's the problem, because everyone can basically
But
buy a property, but buying a good property is a different story.
yeah, in a rising market, I mean, you generally can't go wrong.
Yeah,
But in a stagnant market like we are in now, you need to seek advice, because if you don't, you could end up paying too much, or buying in the wrong suburb.
absolutely.
Yeah.
And this is a very typical conversation that we normally have with certain type of clients, and they said, we can do it ourselves, and definitely I'm sure that they can do it themselves. But at the end of the day, anyone who has enough saving in the bank and enough borrowing capacity can purchase an investment property. Not one they can buy 10, but the amount of capital gain they're gonna get, and the amount of profit that they gonna achieve at the end of the day depends on a solid due diligence system, and the way that they minimize the risk and they manage that risk. It really depends on having that financial background and understanding what's happening in the market in the first place.
Exactly.
But many people just think because they can purchase something, they buying something will basically give them maximum profit, which is not correct.
Yeah, it's always good to, if you're going to invest, I mean, property investment's substantial. I think you can't get much for 500,000 these days. So if it means spending a few thousand more to get an independent opinion, an expert opinion, I think it's worth it. Yeah.
Absolutely. Sometimes you have to spend money to save money, and this is something that I really believe. A good accountant can help you save thousands of dollars on your tax if you find a good accountant and pay them well. And the same thing with the property investing consultant or any other professionals that basically work closely with the client and give them advice.
That's right, because property selection is a science. I mean, there's structured formats that you follow. It's not a question of most people would probably buy in the suburb they live in because they know that suburb, but it's probably not the best place for them to buy.
Absolutely. Or the suburbs that their friends live in, or their friends have already invested. So it's all about following the crowd, basically.
Yeah, or they look at something cheap and affordable. Let's buy in Bendigo, and because it's cheaper, but they don't understand
the risk involved.
Risk, because Bendigo is, it comes down to the linkages, the location, job, economic growth in those areas.
Yeah, absolutely. All very important factors to consider before investing, and understanding how those factors basically affect the supply and demand concept at the end of the day, because that's how
a lot of people think, if I buy cheap, it's going to go up at the same rate as an expensive property.
Correct.
Fallacy and an illogical way of thinking.
Correct. That was a very interesting conversation, Gerald. I really enjoyed it.
Thank you.
So how can people find you?
Well, I mean, we have a website, www.Everest Tax and Property. We're in 29 2 Enterprise Drive, Bandura, if they want to actually come and see me face to face. Certainly the website would be the first port of call.
Sure, absolutely. Thank you very much,
No
Gerald,
worries.
for being here today and unconditionally sharing with my audience. I really appreciate you.
No problem. It's a pleasure.
So if you've liked what you've heard today, please like our channel and leave us a comment. And on that note, this episode is a wrap. We'll see you guys again very soon. Bye for now.
Bye-bye.